Dipen joins us here from HDFC Securities. Let's talk about the market narrative, outperformance and the bond yields. Dipen, good morning. Thank you for joining us. Sub 7% for bond yield. Sub 7%. I'll say it again. Sub 7% for bond yield. Markets are not reacting. Why is that?
Well, I wish I was a macroeconomist. God knows I'm struggling as an analyst. So, yes, it's a little bit of a conundrum. I think it reflects sluggishness in the economy and weak demand more than anything else. So I guess that would more or less explain it. I don't have a great macroeconomic reason to justify this. We are probably sitting on upcoming fiscal slippage. If government has to rev up the economy through fiscal measures, fiscal boosts. Let's say, for example, reducing taxes on basic consumption, things like cement, boosting rural spend through reduction of GST on two-wheelers. I think a lot of that would add up into expanding the fiscal deficit. So I don't see why bond yields should fall. I think one big reason why they could be falling is also having more confidence in the ability of reforms. Divestment could be, I think, the big lever here, and it's not small bits of inconsequential PSUs which might come up, but it could be the big whammy. It could be oil marketing companies. It could be Air India. It could be a whole lot of government sector presence in sectors and industries where it shouldn't be. It could be SAIL for all I know. And these are my aspirations. I'm not saying, and these are my prescriptions for the government. I'm not saying they're likely to do it, but what if they would? So there's a whole lot of possibilities here, frankly.
Dipen, it's nothing but woes that are continuing for the auto sector, elections, tight liquidity. But, a lot of the companies that we've been speaking to are saying that, the new government's measures to revive the economy, monsoon, all of these factors are likely to rev up the overall auto space. We've seen numbers come in from Hero Moto, Maruti was a big disappointment, M&M, etc. Do you think that after 3 consecutive months of fall, that now we are seeing light at the end of the tunnel?
Frankly, let me give you a slightly long-winded and complicated answer to what sounds like a simple question from you. First, we need to understand that autos is, end of the day, a cyclical space, and we were sitting on 2-3 good years of numbers across the space. So some of that had to give. The second thing is that the incremental auto demand is coming in mostly from upcountry markets. As you know, the metros are getting saturated. There's ride share coming in. There is driving difficulty, if I can call it that. A lot of young people, millennials and so on, don't want to buy cars or even bikes anymore. They'd much more use an Uber or something. So the incremental demand was coming in from upcountry areas, and those were the areas which were seriously stressed in terms of economic pain for quite some time. We've had 3, I would say, soft monsoons, and if this one is also going to be soft, then there is serious trouble coming up, although the government has a whole lot of levers. It's very creditable that agricultural output has held up despite indifferent monsoons, but that's a different story. Third point, I think in CVs especially, unless IIP revs up, unless manufacturing revs up, I don't think there's a hope in hell that CVs will revive anytime soon. There's also an emission norm change coming up, so we'll see a little bit of pre-buying happening in Q2, Q3. But I don't think there's a structural case for arguing, a bull run in CVs over the next 3 or 4 years, especially with the DFC coming up. Not just the Delhi-Bombay, but the Eastern DFC also coming up. So I don't think CVs are going to be part of the auto revival as and when that happens. Cars are, of course, consumer discretionary. People can postpone demand. A little bit of bunching up will happen maybe in a year out from now. So that should be good for brand leaders like Maruti. As you can see, the not so strong brands like Tata's have suffered much more in this crack. On two-wheelers, I have a completely different point of view. We are probably sitting on a very, very sweet value zone for two-wheelers. Whether it's Hero, whether it's Bajaj, which are the two largest listed players in the space. Frankly, to my mind, I cannot understand why a pragmatic government would continue to have 28% GST on entry-level two-wheelers at least. So, okay, fine, you can have higher level of GST for Enfield bikes, but why for a 110cc bike, or even for that matter a 150cc bike? If that is kind of brought down to 18%, then I would see very good times for two-wheelers. Both these companies are very high ROIC companies. Bajaj has actually pumped up volumes over the last year. Hero has struggled, but I think the next 2 or 3 years look very interesting for both of these guys.
Dipen, just to have a follow-up question on two-wheelers, the challenge for Bajaj could be that the three-wheeler business, not the two-wheeler business, the three-wheeler business is slowing down, and that was the cash cow. For Hero MotoCorp, the challenge is that they have nothing in exports. So for Bajaj, yes, export is a fillip, but three-wheeler is a challenge, scooters is a challenge, and for Hero MotoCorp, no exports. Very thanda.
Okay, so the longer view on three-wheelers is, one, remember that Bajaj has also got into the freight end of the three-wheeler market, not just the passenger end, and it's been doing very well there. And God knows people like Greaves and Atul have been hit by what Bajaj has achieved. They obviously have a very strong distribution network. On the passenger end of the three-wheeler market, I don't think we've seen the end of it so far. Yes, it's a phenomenally high margin business for Bajaj, but it's not that the other parts of the portfolio are not making money. Having said that, I think even the passenger three-wheeler market is likely to take off if the penetration and what I would say is urbanization led pull for passenger three-wheelers increases in upmarket India. So maybe you don't have too much of scope for selling passenger three-wheelers in a Bombay or a Pune or Delhi, but surely it would be there in Aurangabad, for example. So I think some of that will play out increasingly as government spend and urbanization in tier 2 and tier 3 India plays out. I think a lot of three-wheeler demand will actually play out over the next few years, and I'm not too worried about that part of their portfolio. What people have been worried about on Bajaj is whether they are discounting their way into the entry-level segment in a bid to get volumes all over again. I think that has played out, and they've kind of held their horses there after an initial burst to get their volumes. I think Bajaj now has a much more balanced portfolio mix. Of course, that big gaping hole in scooters continues to bug me for a company which was known as a scooter company many decades ago, but that's a different story again. On Hero, I think the bigger comment, the relevant thing to note is the fact that they've now got into the mid-premium segment, if I can call it that, where they were virtually not present for a long time. And remember, the upselling to the staple Hero crowd in mid-tier India is likely to happen with these models, as well as increased presence in the metros. So I'm not worried on these two companies at all. A little bit of a push from government in the form of reduced GST, perhaps, maybe it's aspirational, but I think it's likely a pragmatic and sensible government would figure out that taxing things like two-wheelers and cement in this country at this point of time at 28% just doesn't make sense.
Do you think that it's imperative we see a rate cut? Because if not, the market would really, or rather that would really open up some serious downside in the market, because the market seems to be assuming or moving along with that assumption that come June 6th, we are going to see a 50 bips a rate cut. At least that is what the bond market seem to be pricing in already.
So if you're stuck with a sluggish economy and low inflation, I think there's very little that governments can do on the monetary front. The RBI can do on the monetary front, except for pushing for a rate cut. And yes, I would agree that 25 bips is a virtual given at this point of time. If they may not engage in heroics and do 50 bips for the simple reason that oil continues to be an uncertainty. But I think apart from monetary stimulus, fiscal stimulus, and as we've said recently in our note on Modi 2.0, policy stimulus is the big hurdle that India has to go through. And this government has now got a clean mandate for a fresh 5-year term. This is the time to do big and bold things, a little bit of fiscal slippage, a little bit of monetary loosening, much as it may sound Keynesian to lots of classical economists, will be forgiven at this stage in Modi 2.0. This is something that Modi 1.0 should have done very early in the game. They did try doing much of this, but it it was getting a little late. So I think right now, monetary stimulus from the RBI, fiscal stimulus from the government, and most important, Modi 2.0, a fat reform agenda, big, bold, aggressive reforms that can completely change the character of the nation and not just 3-month trajectory is called for.
Give me one infra space, Dipen, where you would say, look, I'm convinced that things will only change for better. And structurally and cyclically, these are stocks which can be potentially double or even 3x in this NDA 2 regime.
So let's start by eliminating, it's the global cyclicals are certainly not going to make me that kind of money, whether it's the steel stocks or the non-steel metals, or call them what you will. They are affected through global cycles, which frankly are difficult to predict sitting out of India. So let's rule them out. I think local cyclicals, if I may say so, and I have mentioned cement as well as two-wheelers earlier on in this conversation, are set for policy-led revival and increasing consumption and penetration, especially into upcountry India. The natural beneficiaries of, let's say, a revival in cement, and cement pricing has been very strong in Q4 last year. It continues to be extremely strong in Q1, and I salivate to think what might happen to cement company profits should GST be brought down from 28%. So the natural proxies there would obviously be Ultratech in the large cap space, a Shree maybe, where valuations look stretched to us. If Ultratech looks rich to you, you should take a look at Shree's valuations. They are both well north of $200 a ton. But then something like Dalmia, which has been very consistent in profitability, looks interesting. Birla Corp, which is probably the cheapest 15 million ton cement company, 15 million tons and higher kind of cement company available in India at this point of time. Ramco, which is also not cheap, might make sense in that cycle. And of course, Hero and Bajaj in the two-wheeler space, where I've already outlined my arguments. Another year out from now, maybe if we see a revival in discretionary spending, then maybe four-wheelers can also take off and Maruti can turn out to be a very interesting buy. But that's about it. If you look outside these two sectors, then obviously infra and construction, given the appetite of this government to spend and to drive infrastructure spend. So the old anchor L&T is running up. I don't know whether it's a doubler or a tripler in 3 years, but it's a very, very good proxy for playing the revival in infra spend on a broader base. You will never be as comfortable with L&T's valuations as you might be with some of the small cap stocks. But remember that all the mid caps or small caps in the sector added up, don't quite add up to L&T's market cap or its nifty weight for that matter. So I think L&T is going to be an anchor in any portfolio which is aligned with Modi 2.0. But other than L&T, we like names like KNR Constructions and PNC Infratech. Fat order books, very clean balance sheets, particularly in the case of KNR. They're still sub 50 days, I think, in terms of net working capital cycle. Excellently managed companies, both of them. Much of the fat order book is now going to come into play over the next few years. So there your infra and construction. Local consumption themes, to bring in a third argument, might also be interesting. And I'm not just talking about the 40-50 PE kind of FMCG stocks, but discretionary consumption such as appliances, such as food service. So food service, naturally, Jubilant Foodworks, despite high valuations, continues to be one of our top picks. On the appliances space, we are seeing a scorching summer now finally playing out, and you've seen the run-up in stocks like Symphony. Despite an average quarter, Voltas is set for a good time, despite what people see as a bad quarter in terms of the slippage in its core business segment margins. So there's a couple of names, and of course V-Guard, which is now building out a North India franchise very, very aggressively, and much of its one-time spends on advertising and brand promotion seem to be in the base. So V-Guard is also set for a couple of very, very good years.
Great to have you, Dipen, and glad that you shared all those stock ideas with our viewers as well. Good speaking with you as always.